Hi, welcome everyone to another MakerDAO Collateral call. Today is February 17th, 2021, 6 p.m. UTC, and I'm here with a bunch of people interested in the Maker ecosystem. Today we have another session with real-world assets or real-world finance. So we'll have Nick from Fortunafi presenting their project. We already had them back in December for a brief moment, but hopefully today we can go more in details. So just to give you a quick reminder, if you feel like asking questions or interrupting, go ahead, like very open. Before we start, I don't know, Seb, if you want to give some real-world finance updates, maybe an update on MIP 21 or 22 or what's happening.
Yeah, I don't have much news on MIP 21 and MIP 22. Sadly, the smart contract team is still working hard to make sure that everything is safe, and they are testing MIP 21 as we speak. But I want to thank two teams at Maker, the legal team that helped me a lot last week to see that everything that we are doing on real asset is quite safe. So we are now quite sure about it. And another team, which is business development from the foundation, that is feeding us with a lot of projects lately. And so we will have a lot of work and a new culture in the following the next year. So a lot of work, so awesome. Thanks.
Keeping you busy. Good. Something else I would like to mention is that Seb's sub-proposal for a core unit for real-world assets is out there. So if you want to check it out, it's in the forum. Yeah, so that's it. So Nick, if you want to take it away, I don't know if you have to share a presentation or.
Yep. Thanks, Juan. Yeah, we have a presentation today and then a demo from Derek at Coral, sort of walk you guys through the platform. First of all, before we started, I just wanted to say hello to everyone. Particularly wanted to thank the real world asset risk team at Maker, Phil, Seb, everyone that's been helping me on the chat. Really appreciate the time you've put into this, and looking forward to presenting here for you guys today. So let me share my screen. Great. Can everyone see this window?
Yes.
Fantastic. So for those of you that don't know me, my name is Nick Garcia. I'm the CEO at Fortunafi. At Fortunafi, our goal is to provide institutional yield products for everyone. The founding team is comprised of myself and my co-founder, Jason. We've been in the crypto space for a while. Jason first was a Bitcoin miner back in 2011. I joined the space in 2013. And have been pretty active since then. We started off with a fund called Spacewell Capital, a proprietary investment firm that manages a discretionary liquid trading strategy and actively participates and invests in DeFi. We have always had this thesis that fintech and DeFi had a tremendous amount of value through working together. And we have sort of iterated on that thesis. And over the summer of 2020, we launched what is known as Fortunafi today. And our vision is to bring institutional yield products to DeFi by rebuilding the securitization stack from the ground up. So our approach is to, as this sort of articulates, is to verticalize the entire process from the initial point of asset origination all the way through the end product. So typically, in a traditional process, you would have an asset originator who goes out and does the go-to-market. They bring in an asset, they underwrite it. There's typically a warehouse provider that provides a line of capital for them to fund the loan. Then there is typically a closing process. And then there's typically a takeout partner, which will buy the loan, pool them into eventually create these yield products known as bonds that they will sell to pension funds and sovereign wealth funds. So in that process, there's several intermediaries. It's a lot of costs. It's super inefficient. It's extremely slow. And our vision is really to bring efficiency throughout this whole process by verticalizing it. When we went to market, we really looked at all of the different asset classes to figure out which assets we wanted to, really focus on. And after a lot of research, we decided to hone in on the revenue-based financing space. What's really interesting about this asset class is its risk and return profile. So from a risk perspective, it's very similar to senior debt, where it's the first, it has senior security lien and interest on the underlying company. It's the first payout of the companies. These assets just carry a very low risk given the return potential. The return is much more on par with sort of equity-linked or equity-like instruments. So we really like this asset class, and this is really why we decided to dig in. Another aspect outside of the risk and return profile is sort of the lack of institutional support. So we made the assumption that the best markets for us to enter in would be the markets that have the least institutional warehousing and capital markets infrastructure for it, so that we can sort of tackle that industry and really capitalize on that with our verticalized process. So a little bit of information on the revenue-based financing space for those that are not familiar. Revenue-based financing is an asset. It is not structured as a loan. So this is an asset. When we buy these assets, we're literally buying a portion of the gross revenues that a business generates on a monthly basis. These are typically companies that are SaaS-based revenue companies or e-commerce companies. And so they have predictable revenue that we can essentially buy a portion of. So typically we'll buy around 4% of the monthly gross revenue of each underlying asset. And our assets have a 2-year expiry. And then if the company wants to buy it out or sort of get out of that before the 2-year expiry, they can exercise their buyout option, which is typically around 1 to 3x of the investment, for them to actually buy that back from us. So it's not a fixed payment stream. It's a variable payment stream that fluctuates with their revenue. But these are growing companies that have a track record of growth, that have a track record of a proven business model. And so we feel very comfortable with the risk we're taking given the returns. Also, as I mentioned previously, we do have perfected senior security interest in each underlying business. So in any sort of event of liquidation, we're always the first money out. So when looking at this asset class, it's funny, I actually had to update this slide this morning because when I first created the slide, the global crypto market cap was around $500 billion. And this has grown substantially. But our asset class is still much larger than the entire global crypto market cap, which I think is interesting to think about when you look at the context that this is a relatively new asset class that has pretty much grown from 0 to 2 trillion plus over the last decade. And so this is an emerging asset class. This is an asset class that companies really need. It fits a unique niche in between VC funding and sort of self-funding before companies can generally access high quality bank products or something that makes sense. This has been a very good product that companies have really liked, especially in the SaaS and e-commerce space. So Coral, who we're going to bring on here in a second, Derek is the CEO, thankful to have him on today. Coral is a fantastic business. They have an incredible technology and they're our first asset originator partner. So Coral has built this technology where companies can apply they log in with their bank accounts through Plaid. They connect their accounting systems, whether it's QuickBooks or another system. They basically connect all of their different systems between accounting, cash, marketing, sales. Coral integrates all this data into their proprietary underwriting algorithm, and it calculates a credit score. Deals that pass a certain credit score go to underwriting. The underwriting investment team is comprised of Coral and ourselves, and then we ultimately make the underlying decision on whether to purchase the asset for our pool or not. So a little context on Coral's historical performance. We launched a proof of concept portfolio in 2020. Before we shared the results of a back test on a number of deals that Coral received through its algorithm over the last few years. We shared that in the link in a comment to the MIP6. We also shared that in our underwriting report, but you can see it in the MIP6 as a comment there if you want to see it. But kind of talks about the historical performance of Coral, how these assets have performed over time. And it's very interesting. I would highly encourage you guys to read, and I'll allow Derek to sort of jump in and provide a little bit more context on that. So I think this is probably a good point to turn it over to you, Derek. And Derek's gonna come on and give us a walkthrough of the platform that I sort of illustrated, where you can come in, you can apply, you can sync up all of your data, and it actually does the quantitative scoring and has a whole analytics page that we use to make investment decisions that pass a certain credit score. So Derek, let me stop sharing my screen here, and I will turn it over to you.
Before we jump into Derek, are there any questions for Nick regarding what he just mentioned?
Hi, Nick. This is Tadio. Just to clarify, this is essentially a cash flow based underwriting, right?
Correct, except we're looking at the gross revenues that a company generates. It's not based on an EBITDA type of number.
Okay, so it's gross. It's pure direct method. Okay.
Hey, I don't know if this is going to get covered in the next part of the presentation, but how are you guys custodying these assets? How are you structured?
So, this is, similar to a mortgage paper. It's literally a contract between us and the company. That contract gets tokenized into an NFT through Centrifuge. We're built on top of Centrifuge. And then we deposit that NFT into the pool and withdraw the funding to finance the deal.
Okay.
So custodying is really just a function of legal contracts.
And just to make sure I'm understanding, so like kind of max risk situation, like worst case scenario would be that a company you vetted just starts selling next to nothing, right? That would be kind of the worst case scenario, given that you have the kind of senior debt, I guess.
Sure. I mean, yeah, the absolute worst case scenario, would be where revenue basically drops from some historical reliable performance to literally zero, which, I think is extremely unlikely given that these are mostly SaaS revenue contracts or recurring revenue streams, or sort of like e-commerce sales with history that, really shows sort of adoption of the underlying product. So we really look at all these things, and we're really underwriting to the revenue quality.
Nick, is Coral one of the kind of companies that you're investing in, or is it one of your partners that you use to invest in different projects?
Yep, great question. So Coral is the asset originator. So Coral is doing the go-to-marketing efforts to get inbound deals. So companies that need our product apply through Coral, and they give all their information to Coral, and Coral absorbs this information into their quantitative algorithm that spits out a credit score on the underlying data. I think it'll make a lot more sense once Derek walks through the demo, so you guys can visually see what's going on the Coral side of things. But happy to take any other questions before we turn it over to Derek. And I think we have time as well after the demo for any follow-on questions. Okay. Well, I mean, if there's no other questions, then let's turn it over to Derek.
Great. Thanks, Nick. I'll just share my screen here. And maybe before I just jump in to give you an overview of Coral, I'll just introduce myself. I'm the CEO at Coral. Background is primarily in mathematics, then turned finance. Worked at Scotiabank, a large top 5 bank here in Canada with international exposure, where I worked in model validation. So the bank has hundreds of models that are used to essentially adjudicate risk, provision capital, make business line decisions. And so our group was responsible for validating those models. I then went across Bay Street to KPMG, where I led the quant team in financial risk management. And that's essentially where we were effectively the quant SWAT team for the firm. So any of the clients of KPMG that had more statistical or financially engineered related issues would get sent to our group to solve. I then did my own private consulting after that. Worked with roughly 36 different financial institutions across North America and the Caribbean, solving different fintech as well as finance related issues with them. And then started Coral. Coral is a revenue-based financer, as Nick mentioned. We focus on identifying companies within the digital economy, specifically SaaS, e-commerce, and other digitally enabled businesses, to provide capital to them in the form of what we call revenue sharing, which is, as Nick mentioned, we take a percentage of a business's top line revenue every single month. and the business has the option to buy out our investment or our financing at a multiple to the amount that we provided. It's quite a simple structure, but as you'll identify, it's a nice alternative to traditional venture equity, whereby the cost of capital could be, well, thousands of percent, whereas the alternative with us is, call it anywhere from 25% to 100% on an annualized basis, depending on the revenue growth of the businesses. So it is a financially beneficial alternative to what is out there in the market. And this industry itself, this asset class is quite emergent. And we're going to see a lot of growth and have seen a ton of growth since our inception in 2016. Since 2016, over the past few years, we really focused on building out a tech stack that enabled us to onboard a business in under 10 minutes, being able to connect to all their data points so that we can use it to evaluate financing decisions. What I'm going to do today is take you through a high level what that onboarding process looks like for a business, what types of data sets that we're getting access to, how we're evaluating these businesses for the purposes of extending capital to them. And then I'm happy to go through any details along the way if there's questions. So as a business, they would land on our website and essentially click apply now. For the sake of time, rather than going through every single field here, what I'm going to do is just kind of bring you through the steps of the application process. So what you'll see here is essentially this first page. This is the account opening page, so we can collect some information to contact the owners of the business or the individuals that are applying for the capital. The second page is more for KYB related address information. We want to know how long the business has been in existence, the corporate structure, the number of employees, the category of the business, which could vary. For example, is it a SaaS business? Is it e-commerce? As this will essentially impact the analysis that we perform. This third page is a quick financial summary on the business. This lets us know where they are in their maturation as a business entity. Also, we want to find out how much money that are they actually looking for. We tend to not issue capital that's several multiples above what they're currently making in monthly revenue. And our risk-based pricing algorithms that determine the contract terms are modeled in such a way to maximize and optimize the risk-adjusted return on capital for us as a firm. So all of these inputs are quite important into us actually determining the terms that we issue to the business. But what's even more important is all of this granular data that we're getting access to. So if a business approaches us and they have online connections to banking, accounting, or payment processor platforms, we will require them to connect at this page, where we're going to be essentially pulling in transactions from different deposit accounts over the last at least 90 days. What's really the most important here is on the accounting side. We end up taking in all of the transactions in a business's accounting software system since inception. So this could go back several years. We're also pulling in their financial statements, whether it's income statements, balance sheets, cash flow statements, trial balances, all of the pertinent reports that would allow us to make some valid underwriting decisions are pulled in as well.
Hey, I'm sorry, Derek. Derek, sorry. Sorry to interrupt. Are you changing the screen at all?
Yeah, Derek, I think you're stuck at the account creation page here.
Oh, okay.
I think you shared it on the, looks like Chrome that you have up.
Okay, I'm gonna do a quick reshare here so that we can get my desktop. And yes. Can you see this?
Yeah, can you take us?
Yes, that's better.
The page? I think that's at least just visually so they can see it. Yeah, thanks.
Okay, yeah, I appreciate that. Thanks for letting me know, Phil. So the account page here is what I mentioned before to grab the contact information on the business. Company page here is how we're collecting essentially the structure, the number of employees, the business category, which is used in the modeling. Financial summary is just a snapshot, high level of the business. And so you can see here some of the fields that we're pulling in: operating expenses, how much capital the company needs, revenue, the purpose of financing, all quite valid fields that are pretty common in typical credit applications. And then here is really kind of the meat and potatoes of what we're collecting in terms of valuable information from a business. As I mentioned, 90 days of transactions, at least on the banking side, every transaction on the accounting side that we have access to, and about, if I were to kind of weight the inputs into our overall model, I'd say that well over 65–70% of our model is based off of these more quantitative or financial risk metrics that we're able to compute from this data. Also, if there's marketing information that we can pull in, Google Analytics, for example, we're going to be able to grab that on this page as well. By the time that the business actually completes the connections and authorizes us access to all of this information, we have a very good picture of how the business is operating, at least for the snapshot point in time, as well as historically. And that forms the basis for our underwriting decisions. This next page here is more KYB. It's collecting information on the beneficial owners. And this is no different than any typical credit application process. So by the time that the business finishes this application, they're able to complete it in under 10 minutes, as I mentioned. They are redirected to our business portal, which just gives them a quick overview of the amount that they've requested, how much they're qualified, and the status of their application. So for this particular example we're looking at, the application was completed and now it's under review. And then now it's up to Coral to go to work, so to say, and evaluate this business for financing. And so the next part of this demo that I'll show you is essentially what Coral sees on their side. So this is our what we call the Coral Explorer. It allows us to review all of the applicants that have come through the website. We can create and review different investment reports that we automate and create at the time of application completion, which provides a snapshot of the business, as I mentioned before. It also allows us to get into any uploaded materials that the business would have provided through the business portal. So articles of incorporation, cap tables, anything that would be necessary for us to perform our legal due diligence would be pertinent here in the data room. But really what's the most important thing to notice here is the investment score. So as you imagine, it's really important for us to have kind of an apples to apples comparison across all the companies that apply for financing with us, because as this model has been built out over time, we have thousands of businesses that have provided data to us. We get thousands of applicants a year, and it's important for us to not spend time on every single one, but really just take a look at the businesses that have a high risk return potential. So we've developed an investment score that takes in all the various data points. On average for a business, we're talking roughly about 10,000 different data points to compute a score between 0 and 1,000. Obviously, the higher the score, the better. And then any score that's greater than 740 is what we would consider internally as a BBB+, and that is the threshold for us to consider investment. So I have a number of fake accounts showing here on the screen. This is our portfolio search tab. So we can essentially review information from the application process on these businesses, which gives us kind of an overview of their monthly operating costs, cash balances, and any usual information that we might want to capture on the applicant itself. Now, this is just high level. What's really the most exciting part of what we've built out here is the investment report. So as I mentioned, as a business completes their application process, we automatically generate a report. And this report represents a snapshot for any given point in time on a business. So we're talking about company information, kind of address, location, team information, who are the shareholders. So this would have been inputted on the ownership page. We have banking information. So if a business connects their bank accounts, we're going to be able to see not only the deposit accounts, but also if they have any credit products associated with their banking provider. So this could be credit cards or loans. You can see here daily, weekly, monthly snapshots of their bank accounts on a consolidated basis over time. We can see transaction summaries. So the amounts of inflows and outflows, transactions that are being made within those accounts, their balances, any NSF fees that have maybe been triggered as a result of missed payments and lack of liquidity. We can also see, as I mentioned, credit card accounts. So this is important, obviously, to do categorization, to understand where the money is being spent on the business. And we can see here a breakdown by category as well, including debits and credits from different types of transactions. So all of this would be obviously inputted into our investment scoring. And what's really the most exciting part of the report, from my perspective, is the accounting section, the financial section. This is where we get the majority of our data on the business. We can get a high-level snapshot of how they compare against other companies in the portfolio. We can take a look at the income statements. So obviously this is just kind of a fake business, but you can see expenses over time, how they trend on a monthly basis. You can see balance sheet data, assets, liabilities, equity over time. You can see cash flow statements as well. So any split of cash flow between financing, investing, and operating activities would be available here. We compute financial ratios on the business, and this gives us an indication of the profitability, leverage, activity, liquidity of the business itself. We have our standard financial statements if you want to look at them in kind of a universal format. As a credit analyst, income statement, balance sheet, and trial balance is available. Finally, we do compute financial projections. So we have internal models that are being used to forecast the statements on a pro forma basis based on historical transactions. And these are essentially used as inputs to our risk-based pricing engine to determine the terms of our investment. Obviously, the same is done here for the balance sheet. Finally, we get into some of the more relevant metrics for making investment decisions. So probability of default, we have an internal model that is used to compute what we believe the PD of the business is on a forecasted basis, both in the event that we invest and don't invest in the business. We have liquidation values. So essentially what this is if there is an event of default, how much might we be able to recover in a liquidation? And so this involves essentially analyzing the balance sheet, providing certain forecasts and haircuts with different line items to come up with what the net liquidity would be after a recovery process. And then exposure at default, which in this case would be effectively linear over time given the investment itself. Expected loss is how we're evaluating the total loss on a financial basis for a given business. For those from the credit side, they'll know that that's effectively the PD times the LGD times the EAD, which helps us understand essentially what our total amount at risk would be in both the event that the business does well as does not do well. Expected return it obviously depends on the amount of years or the duration of the investment contract. For purposes with Fortunafi, we are using a 24-month term. So we're able to essentially have the contract be bought out at every 24-month period. Finally, the last few sections here, valuation. We want to know actually how well the business may be valued at in the future, because this actually impacts future funding rounds. You can think of our interest or investment as a non-dilutive instrument, but not all companies always look to acquire debt or other non-dilutive capital options, some do offer equity. And so we have a way of essentially valuing the business among 8+ different methodologies that are pretty common in the industry in order to determine what the value of the business might be at future financing rounds, which helps with assigning probabilities of future funding events. This last section here is more about benchmarking. It's really comparing the business against not only the portfolio itself, but other companies within its sector, and for different dimensions of revenue, cost of goods sold, other financial ratios, etc., so that we can determine whether they're exceeding expectations or where they fall in that distribution relative to their peers. So at a high level, that's the business report. It covers a lot of detail on the business itself. When we are ready to make a financing decision on a business and it has passed an investment committee review, we can initiate that investment from within the portal here in the deal summary tab. So we can set an investment date, we can set the investment amount, we can modify the terms of the investment, as well as any types of disbursements if they may be needed. We can initiate the contract creation, and that would essentially trigger the contract to be sent to the business so that we can start the process of funding. What you'll notice here on the side is there's obviously some statistics related to the return potential of the business relative to the deal parameters, and these would change accordingly based on the amount that we decide to invest. So in essence, that's what Coral does. We are a capital as a service provider, providing revenue-based financing using a very automated technology-driven system. We have helped not only our own portfolio grow and exceed expectations, but we also, using our technology, have provided the government of Canada with it so that they could help finance women-led businesses and minority-led businesses across the country. As part of a COVID relief program, we've helped them deploy millions of dollars in capital over the past few years, and we'll continue to do so both for them as well as with our partner Fortunafi. Happy to answer any questions that you may have on the process or about Coral in general.
I think Greg had a couple questions. I know I just had a brief one. Is the report rundown you're walking us through, is there like a public version or something that like anyone could access when you do choose to fund one of these companies?
So given the level of detail that's in this particular report, we tend to not make this public. What we can do is make a consolidated or more privatized version, publicized version of it for public consumption. It wouldn't contain transactions and who are the counterparties of the business, but it can contain relevant information for investment purposes that may be needed.
Awesome, thanks.
Yeah, I did have a quick question on the data. So I see that you're pulling from these APIs, but do you ever offer the client the opportunity to input the data themselves? And to what extent do you go through the data and verify that it's accurate, even if it's being pulled from an API?
Yeah, so we don't allow the business to necessarily upload information that would get then run through our models, because if everyone's just uploading different Excel files, like it's almost impossible to tell which ones to rely on, what are the fields. There's a lot of inconsistencies. So
I hope you say that.
Yeah, so we got to make sure that the input data is pretty consistent there. In terms of the APIs themselves, we use for our banking provider, MX, which is well-known financial data aggregator. They pull data directly from the bank accounts themselves. So if there's erroneous information within the bank account, then it would come through. But we're talking about people's financial data, and most banks are pretty good about not making mistakes. In terms of the accounting information, we have built out those direct API integrations ourselves. And so when we look at the information that's getting streamed through from QuickBooks or Xero or Sage or different accounting platforms, we're relying on the attestation of the business owner that information has been filled out properly. Everyone has their own unique idiosyncratic ways of doing accounting, but on a general basis, we undergo what we call normalization. So we're mapping the accounts within the businesses to our own standard hierarchy, so that we can ensure that we're making apples to apples comparisons across all the businesses, regardless of their own unique accounting practices. Moreover, when you look at the accounting platform data that we're getting in, many accounting platforms will allow you to connect your banking or your credit or your loan applications or payment processors. So a lot of the information that we're getting fed through the accounting platform can be independently verified from the banking data or the payment processor data sources that we have.
Got it. And do you ensure that the companies are getting regular audits or that their accounting is being done by a CPA?
We make sure that they submit on an annual basis their tax filings, which we can then use to identify any discrepancies between what they've reported to us and then what they report to the government. There's no legal requirement that we put in our contracts for CPAs to be involved throughout the year, but you know, if it's good enough for the government, then it's good enough for us.
Yeah, that's pretty good standard.
Yeah.
Thank you.
You're welcome.
Planet X wrote in the chat. I'm going to paraphrase a bit. Maybe this is more for you, Nick. Like, do you guys have an idea of the volume of these pools and, I don't know, potential growth?
Yes. So we have a massive pipeline of assets coming through Core right now. We've been scaling the origination efforts. We've asked in our MIP 6 to start off with 5 in terms of the vault, and then to scale that up to 20. We think we'll be easily able to fill that up this year. We'll likely come back for another increase once we fill those up and prove out our model with you guys in partnership.
Good.
Does that answer your question, Planet X?
Oh yeah, I wasn't sure the microphone was working. Between 5 and 20 million. Okay, that's fine.
Yeah, just for context, and we launched the platform in June of 2018, and within the first 2 years of going live, we had well over $150 million worth of applications, requests for financing, and we, given our risk approach or risk policies internally, we don't expect to finance more than 10% of these businesses, just because it's a highly selective criteria. But at the same point in time, that was the first 2 years of business. We're now hundreds of millions of dollars of applications coming through, and we've done a number of different back tests as well, using the data that we've been able to procure on these businesses. And so 20 million is not even inconceivable to where we're at today, being able to deploy that within a few months period of time.
All right, thank you.
I saw Tadeo send a question in terms of target profile. I think we addressed it earlier, but just to highlight it.
Yeah, the questions for Nick. Oh, sorry.
Sorry, it sounds like a little connection issue. But I can sort of repeat the question and the answer for the larger group and for the video. The question is, what is the target client, SaaS companies, what size or maturity? We are targeting companies in the digital economy, including both SaaS companies and e-commerce companies. I'll let sort of Derek, if you want to touch on, sort of the average size of the companies that we're seeing so far.
Yeah, so just to give you a sense of like minimum eligibility for financing for us is at least 50,000 in monthly revenue, and that's a minimum. On average, we're seeing companies with a few $100,000 in monthly revenue. You can think of these on kind of that venture scale as companies that are pre-A, Series A, or post-A. These are high growth companies that have established product market fit. They're looking for excess capital in order to scale up their revenue growth activities. We really are growth capital. We're not working capital. As Nick mentioned, primarily e-commerce and SaaS. Almost over 90% of all of the revenue from these businesses would be generated online through various sources. They don't necessarily need to be profitable, but what we tend to find is that there is a clear path to profitability and a trend towards cash flow positivity over time by the time we make the investment. High level, these companies don't necessarily need to have any prior funding rounds. They often do have, let's say, 1, maybe 2 venture investments prior. And what we often see is we're a supplement to equity capital or a complete alternative. Many second and third time founders will come to us and say that they've kind of gone through the venture capital life cycle before and ended up with a very small percentage of their company by the time there was an eventual liquidity event. And so they're doing it a different time or a different way this time around, where they want to essentially access more non-dilutive capital options for them to seed that growth into the future. So those are kind of the characteristics of the businesses that we're looking at. Almost in every case, there's at least 24 months of an operating history there that we can rely on to ensure that there's a level of reliability in the models and the scores that we compute.
Sounds good. Do you have any other questions for Nick or Derek?
I guess I had a question. I know the community greenlight poll just went live for the Fortunafi drop token. Was curious if might be worthwhile explaining like kind of what that token is or like what it tracks essentially. Is it the basket of the entirety, just a few you're selecting? Yeah.
Absolutely, great question. So, for those of you that are familiar with the centrifuge model, it's typically a 2-tranche structure where you have your primary tranche, also known as drop, and your secondary tranche, also known as tin. So our application for the MIP6 is for the primary tranche, the drop tranche, which currently pays out a 10% APY per year, and it's a 2-year asset. So the 10 tranche is totally funded by ourselves, and we keep that internally, and we will use the drop token for collateral for Maker, which I believe is the same model that other centrifuge assets have utilized.
I think it's worth explaining it for users that are here and see this as a first introduction to centrifuge. All right. Any other questions before we call it?
We have a few minutes. I wonder, Derek, would you mind talking through the backtest that you've posted in the MIP6?
Yeah, that'd be great.
Sure. So let me just reshare my screen here, and I can pull up this Excel file. Can everyone see this? Okay.
Yeah, we see the Chrome for Coral Explorer.
Chapter 3 banking.
Okay, let me.
Excel. That's for sure.
Yeah, I need to share an Excel spreadsheet with you guys. Here we go. Okay, so this is the results of a backtest that we performed essentially since we went live on June of 2018. We tracked businesses' data over a period of 24 months thereafter, essentially collecting information on the applicants through the Coral.io website. And we were able to source significant amount of data on these businesses, obviously across banking, accounting, payment processor information. And what we were able to do is essentially compute a score on every single business at the point in time that they applied. So we tracked actually over 1,000 companies over this 24-month period. And from the score that we calculated, we essentially made an assumption whereby if the score was greater than 790, which to us is a pretty high threshold given the quality of assets that have entered the application process, then we would make an investment into that business up to a maximum of $2 million. based on the amount that they've requested. The terms of the investment itself, that was determined by our risk-based pricing engine, which is a function of all the data that we're procuring on the business. And it spits out essentially two parameters. The royalty rate, which is the percentage of revenue that we take on a monthly basis, as well as the contract buyout rate. So this is the amount that a business would have to pay us in order to exit the contract. And both of those determine essentially our overall return as a issuer of credit. And then once we've made that assumed investment, we tracked it over a period of 24 months thereafter. 24 months is obviously the investment contract term that we are working with under Fortunafi. And we measured the monthly revenue figures and the payments to Coral over that period of time, assuming that investment. What we've been able to come up with here is really kind of a high-level summary of the return profile of that portfolio from the invested businesses using that backtest design. And what we've been able to come up with here is essentially pre-loss and post-loss figures for the return on the portfolio. So just going into the pre-loss figures here, what this represents is all the cash receipts that the portfolio received over that period of time from the 24-month investment period for businesses that would have paid Coral a royalty and a contract buyout rate. So the royalty payments would be received on a monthly basis, and you can kind of see that here from the graph. And then the contract buyouts would be made after 24 months duration for each one of these business investments. As I mentioned, both the terms of the royalty rate as well as the buyout rate are determined algorithmically. There was nothing, no expert judgment used as part of this backtest. No exceptions were introduced as a result of, call it qualitative assessments being done on the back end. This is a pure quantitative backtest based off of the results and the data that we have access to. We assume that on an annual basis, we would have essentially a loss rate of about 16.5%, which factors in a PD of 19% and a loss given default of 87%. And we applied that against the portfolio payments. So if we assume on an annual basis that 16.5% of the portfolio is not ever recovered or is lost in default, then we end up with an annualized IRR of about 35, 36%. That is in line with what our expectations are for the portfolio that we are building with Centrifuge and Fortunafi. We believe that this has quite a large spread, a buffer from a risk standpoint to cover any payouts on drop, in addition to the TIN allocation itself, which is made by us as partners in the portfolio. So just one brief comment is that typically when you're running backtests like this, you would demonstrate results that are shown to be in sample. What I want to stress here is that these are out of sample results, meaning the models, the risk return models that we've developed internally were not trained on the data that we applied this backtest to. It was done independent of that. And therefore, this represents a true out of sample, out of time test for the models that we're relying on for underwriting at Coral.
Thanks.
Very interesting. Thank you, Derek and Phil. Any last questions or comments? So Nick and Derek, you've already mentioned the websites of the projects, but I don't know if you want to maybe mention them again and say where people can find you. I don't know if you're on Twitter, LinkedIn, or
yeah,
other
absolutely.
platform.
Our website's fortunafy.com, and Corals is coral.io. I will circulate a couple links on the calendar invite. If that's, I don't know if that goes to too many people or if I should just post it in here. Any thoughts on that?
I think the forum is the best part since everything's collected there.
Then I will reply on the forum with the relevant links so you guys can have it. It's also included in the MIP6, the links for the several companies.
Great. So thank you guys for coming. Just as a minor update, next week we're going to be speaking with Kane from Synthetics, and we'll have the call slightly later since he's in Sydney, I believe. So we're going to have it at 9 UTC, or maybe it's 8. I can't remember. So yeah, join us next Wednesday to speak with Synthetics, and let's keep the conversations going in the forum. Thank you, everyone.
Great. Thank you very much.
Thank you.
Thanks, guys.
Thanks.
Take
Thank
care.
you.